Thank you all for joining us here at the IIF. We've presented here half a dozen times, so I'm going to try to do this as a bit more of an update for hopefully for our shareholders and those that have been following our company for a while. And so this is our February corporate presentation. We'll have this up on the website in some various fashion here in the next couple of days. We put out our guidance just recently, and it's very similar to what we had in the past. The company has gone through some pretty rapid growth over the last 3 years through some successful drilling programs and some strategic acquisitions. So we've gone from basically just a couple hundred barrels a day at the start of 2021, and we're now expecting Q4 to be pretty close to 27,000 BOE a day. We peaked up closer to 28,000 in December last year after a pretty robust drilling program in Q4. And going forward, we're looking to maintain that production level, plus or minus 27,000 BOE a day. By BOE, I mean just probably north of 80% of that being light oil and liquids, the high margin hydrocarbons, and then the balance being about 20% natural gas. So we've looking out for next year within our midpoint of our EBITDA estimates is somewhere about $365 million of EBITDA. We're targeting about $1 million of EBITDA per day. And as well for that, we're looking to get close to about $2 per share of cash flow. You consider that something close to, I would say, about just about $1 of free cash flow. About 50% of our cash flow goes towards capex, and then the remaining 50% goes towards paying down the debt, which we paid down quite rapidly, and I'll touch on that as well. So at around $2 per share, or $1.95 share of cash flow, shares are trading about $2.30 right now, Canadian dollars on the TSX. So we're about 1.2 times cash flow, a pretty inexpensive trading multiple, certainly to compare to the rest of our Canadian peers. So now's an excellent time to look back after our drilling program in 2023 and count the successes and learn from the other lessons that we had. But all in all, it was a fantastic year of drilling, and that culminates in our recent reserve report that Ryder Scott put out on us. It's the earliest we've ever put out our reserve report, but basically that's our scorecard of how well did we do last year for drilling. So far we have the results of 33 of the 45 wells we drilled last year. A handful of them, actually about 3 of them, we started drilling and preparing late last year in December. These were Cardium wells in central Alberta. And so we were budgeting 48 wells for the year. 3 of those will slip into the 2024 budget. We got going on them, but we count the wells once we release the rig for the calendar year. So with the 33 wells we drilled across Alberta, west central Saskatchewan, and the southeast Saskatchewan, all in all, about 24% above our type curve, or what we use in our budgeting. And so that allows us to see that we had some great success in the field. I will highlight the most recent release we put out earlier this year in January was in southeast Saskatchewan in our Bakken field in the Viewfield area. We were able to we did a multilateral open hole well design where we drilled 8 wells off a single well bore, so 8 horizontals, and I'll get into that a bit. But we're delighted that that well came in at about 233 barrels a day for the first 30 days. That's about 50% above our expectations. So a fantastic well. And I mean, the one thing you can see about all these wells is that we've drilled, there's various capital components to each of the wells. There's a different amount of IP30 or hydrocarbons that come on production for the first month. But what balances them all out and puts them on a level playing field is how much does it cost to bring on a barrel per day. In the case of southeast Saskatchewan Bakken well that was OHML drilled, the first time in our company's history, we got below $10,000 per barrel a day of new production. So that's a great achievement for ourselves and a very good indication that this will be a big play for us going forward. It's something that just developed in the last year, really, that's come to fruition. So at continuation of this, we have probably another dozen wells to get into the public domain here, and we look forward to reporting those very, very shortly. And so we were targeting initially $160 million budget last year. And as you know, we had some troubles with Alberta wildfires. We were a little bit slow getting into the field. I want to touch on the open hole multilateral wells. We drilled two of them in the Viewfield area in southeast Saskatchewan last year. Like I said, the first one came out 233 barrels a day. The second one came on quite nicely, not quite to that high of an IP. So they'll average out above our type curve. And I think we've got a pretty good start to this program of our first wells. On the map on the left-hand side, the purple well bores, you can see they branch out between 5 to 8 horizontal well bores per vertical well. And each of those now, there's about, they cost between $2 to $3 million. And the industry has really been ahead of it. Probably about 20 to 25 of these were drilled last year. Pretty exciting stuff. We're delighted with the IPs in our first well. Looking forward to our second well news coming out in the next coming weeks. And we will drill two of these as well here in the first half of 2024. We're not necessarily taking a cautious stake, but when you're drilling 8 legs for every well, this will take us probably over a month and a half to do each well. It's a lot of drilling. You save quite a bit of money on the completion side of things because you don't need hydraulic stimulation. But this is a new drilling technique that's opening up this area. None of this land that we're holding was economic before, and so we're seeing good results in the industry and good results by ourselves. So this could be an exciting new play for Saturn going forward here in 2024. So we've updated this. Not much is different in terms of our strategy. We hold assets across Alberta and then on both sides of the border for Saskatchewan and the southeast and the west central. And all of these assets are focused on oil development. We put out our Q3 late last year in November, hit $100 million EBITDA. That's what we probably expect probably in for thereabouts plus or minus in the coming quarters. And we're guiding to about 365 for 2024. I want to touch on something about our netbacks. We include our netbacks with derivatives. That's our hedging. And you can see that every year from 2021 to 2022, big increase in our netbacks. And even though the oil price fell in 2023 vis-a-vis 2022, we've been able to hold our netbacks. We've been reducing our operating costs, reducing our royalties. What I also wanted to focus in here as well is new wells that we drill. I pick on Saskatchewan here. We get a royalty holiday where we have about 2% royalties on the initial production rates, and it's an incentive for the government to get new production, as well as our operating costs on new wells is somewhere below $10 per barrel. So if oil is about $75 US, in Canada, we're going to see an $85 barrel netback after royalties and after operating costs on our initial production. And what this really points out is that the most economic wells that we have on are our newest wells with the highest production and the lowest royalties. Speaking of both the Oxbow area, we've updated this now. It's certainly our cash cow. It's where a majority of our light oil comes from. We're about 12,550 barrels a day in this area, looking to keep it flat. We've updated this now 518 booked locations in this area, and a lot of this is including our new locations in the Bakken and the Viewfield area, some of the most economic locations in Canada. And we look forward to tapping into this robust inventory here in 2024 and for years to come, including our unbooked locations, which our geologists have gone around and looked at other economic areas that didn't get into the Ryder-Scott report, we have another 300 plus locations. So you're somewhere north of 800 locations at our current drilling pace. We've drilled 25 wells in the each of the past 2 years in this area, and we'll continue to probably step that up somewhere closer to 35 to 40 wells in 2024. And we get a very quick turnaround time from drilling to put new production online, because we control all the infrastructure here. 4,000 kilometers of pipeline and dozens of facilities that we operate and have capacity. So 2024 is going to be an exciting year. I think what we've seen here is year over year, the drilling has got better. We've been able to kind of refine our targets and follow up on our wins. So we're pretty excited to see what we can put up here for 2024. Last slide I'll talk to, we put out our new guidance. Like I said, plus or minus 27,000. The highlights here is that it'll fully fund a development capital of $146 million. We also earmarked an additional $12 million for decommissioning and abandonment obligations on our land, cleaning up. So we're looking for decreasing net debt from $180 million year over year, paying that back, and as well as getting, basically our cash flow is about $1.88 to $1.98 per share, and just maintaining that while we rapidly pay down debt. And the idea is, once that debt is repaid and we maintain the enterprise value, we should see a nice lift in the stock price. So I will leave it there. I'll turn it back to Matthias, and
thanks, Kevin.
And happy to take some questions, because I think there should be some, probably, because I'll let everybody know we're in the middle of an equity offering, and that's something that we will be closing on tomorrow. And so what we did is to make this program work and to get to a robust $146 million drilling program for next year, we're closing on a $50 million financing. It was done at $2.25, about pretty close to market. It went to our 4 largest U.S. institutional shareholders. They saw that the great return we're making on our drilling program last year, and want to encourage us to kick it up a little bit and make sure that we're still making a great return on capital. It's a lifeblood of an oil and gas company, and so that it was a 4-month hold stock. So our current shareholders kind of backed in to pop up a little more capital into the system for 2024.
Yeah, the first question from chat is actually about the private placement, and maybe you can talk a bit more about the background of it, and does it enable the company to replace the Dell loans, or the question is, why would you dilute shareholders?
Right. So we're faced with probably 2 prospects. When we first took on this acquisition of Ridgeback about a year ago today, where we closed that at the end of February last year, oil prices were north of $80, and we paid down probably about, since the time we took that loan, we paid down $175 million of debt. So we have been rapidly paying down the debt. Had to defer a couple payments last year just to keep the capital program going. In Q4, we added a 3rd drilling rig just to expedite the capital expenditures by year end. So we're certainly at a position where we're faced now going forward is, are we going to either slow down on the debt payments, or are we going to let the production levels slide a little bit as we pay down that debt? So critical for us, paying down the debt. I think that's one of the big reasons why we are such a bargain as we are now. And we've got another $180 million of debt repayments ahead of us just to get to the middle of this year. And so we think we've now fully funded from it. And the new capital program, our shareholders made a decision is that, they would prefer to see the debt paid down and the production level maintained. And then at the end of the day, you get a pretty good idea that we'll be about the same production level, same cash flows, and just less of it goes towards paying down debt. and less of it goes to interest payments. So I think it's going to be a big win for shareholders. And there was a little bit of dilution, certainly. I think that our net asset value before was $6.70 on a PDP, call it $6.10 now. So probably a 9.5% dilution to that. But I think that it's what you can do with that money and reinvesting it and getting recycle ratios, north of 2 and 3 times means we're adding value to our shareholders.
Okay. And there's another question from the chat. So you want to drill more, but the production stays flat. So how is it possible when you start in 2024 with 28,000 barrels a day?
Right. Well, I mean, what happens is, I mean, we report kind of where our production levels are, but we had just finished a program drilling with 3 rigs. As most people know in the oil and gas business, the best production you have is typically in your first month. Thereafter, that production level tends to come down by natural declines. It varies from oil reservoir to oil reservoir, but when we hit the 28, basically it was a good indication of the strength of that drill program. And now we're budgeting and keeping it flat at 27. So I would say there was some, I guess, some flush production that was part of that number. But going forward, we're about 22% decline. So we have to replace about 6,000 BOE a day every year to keep our production level flat. And that's where our CapEx comes in at.
And another one from the chat. So the Ridgeback acquisition was great for the company, but it's not reflected in the share price. And why is that?
Well, I think, we did it with the idea that there's a large, robust amount of cash flow that comes off the Ridgeback asset. It was doing more than $300 million of cash flow per year. So that was the money that we were used to pay down the debt. We continue to pay down the debt. And I mean, after paying down $175 million of debt, we have not seen that transfer to the equity value yet. And I think as we continue to pay that down, I think that, eventually, our multiple keeps contracting as we pay down that debt. So to that point, I think it's just a matter of time until we get to the point where we've taken that debt. We've about 1.3 times debt to EBITDA at the end of 2023. We look to get the 0.7 to 0.8 times by year end this year. So if leverage is the issue, I think that certainly we've got our built-in solution to that because we could just use our own cash flows to pay down that debt.
And a rather short question. So what's the current production per day?
Yeah, we're right around our target of about 27,000 BOE a day. We're probably down a little bit from December. I mean, oil and gas production varies. Obviously, we'll be heading into breakup pretty shortly. Luckily enough, we're going to have one of our wells drilling that Bakken OHML well right through breakup. So we'll continue. Usually it's difficult for oil and gas companies to get anything done in the field because the snow melts and you can't access the field. So we usually stop drilling. And then typically we see a decline in production and that gets lifted back up in Q3 and Q4. So there is cycles within the year. And so, yeah, I mean, the production goes up and down, but on average, I think we'll be between that range of, plus or minus 27,000 BOE a day and maintain those production levels where we're about now.
Okay. And would it make sense to refinance the Dell loan with a bank loan?
It makes a lot of sense. Obviously, I think one of the things is, we do have a bit of I would say, an appropriate interest rate, given the fact that our term loan facility has financed 70 to 80% of our last 2 acquisitions. And so that was just north of $600 million of principal when we made that acquisition. We'll be repay about half of that. So the debt will be closer to $300 million by later this year. So at that point in time, less leverage typically means a lower coupon payment, and we do have the right to prepay that debt back to our senior lender right now.
Okay. And another question was from the chat. So the average target price is around $6, but the capital raise is at 2 point something. Why? How does that make sense?
Yes. I mean, obviously, those are future target prices that are based on, whatever number of assumptions that the research analyst makes, but that's basically where they think the stock is going. We would love the ability to go out and use the future price to finance today, but at this, we were basically we're stuck to where the market is right now, and we felt that this was the best thing to do with for shareholders. Now, I myself and the rest of the management team, we put out a news release there in December that we had all purchased the top 9 managers here at Saturn have all purchased new shares. One of the Ridgeback legacy shareholders had a block of shares that they were interested in divesting. So myself, our CEO, John Jeffrey, probably took the largest piece of those at about probably 25% of what was there. But all the managers, we all put in total additional $2 million from our savings into the company, and we're delighted that our top shareholders have also put in their tens of millions of dollars to back us. And so we spent a lot of time with them, as we try to do with every shareholder, showing them the vision of how fantastic the drilling is going and how critical this year is 2024 to rapidly repay down debt. So I think it'd be an exciting year for shareholders this year, and we've got off to a fantastic drilling program already. So got some good results, I think, to show shareholders, but more importantly is just knocking down that debt.
And how does Saturn ensure the efficient allocation of capital towards the most economic light oil development place in North America?
Yeah, we have a floor full of engineers and geologists and geoscientists that go back and look back at all our past results and look where our wins have been, and then looking at how they can recreate that in similar areas. And so, we've had great success in the Viking. I think that 2 years ago we were getting over 90 barrels a day for IP30s. Last year we were over 100 barrels a day for IP30s, and really it's just chasing our winners and taking some lessons for ones that didn't work out quite as well. We'll drill, when you're drilling 50 wells, you take the wins where you can, and I think that already we're seeing some good results from that experience this year already.
Okay, Kevin, the time's already up. Thank you very much.
Great. Thanks, Matthias.